Okay, and welcome back. And now we will talk about Black Thursday that happened the 12th of March 2020. We just looked into on-chain data and we analyzed all the different events that happened in throughout the DeFi ecosystem for the last couple of months. And yeah, as we saw, a lot of things have happened. And one of the major events that happened in crypto, actually since its inception, was Black Thursday on the 12th of March 2020. Besides Black Thursday in crypto, this was also a Black Thursday for the traditional financial markets. So we are all aware of this weird, interesting COVID-19 situation that's going on. And basically, the whole world economy came to a halt, and the stock markets have been crashing like crazy. And crypto was not saved from this, so we also had a crypto crash. And because we have a pretty young market, the crash in crypto was multitudes more severe than the crash that we saw throughout the traditional financial markets. Yeah, it's a big setback for the sector, but we actually learned a lot of different lessons from it. And decentralized finance, but also crypto in general, is an anti-fragile system. So we will only become stronger if we face situations like this. I will explain to you what I mean by anti-fragile at the end of this section. So stay tuned. Yeah, so in my opinion, the Black Thursday in crypto that's happened is in general a sign of a maturing market. So we can see that the market is getting more mature once we will have an actual Black Thursday in a decentralized financial ecosystem. Because before we didn't have we had a lot of different events that happened to the market, but this was really severe market and really also a little bit correlated to the traditional market. But actually, right now you can see that the traditional market is still kind of struggling. They're printing money. We're kind of recovering already a bit more. We're gonna go into that in a bit. All right, so let's take a look at the closer look at what happened during Black Thursday. And there was crazy market action as the COVID-19 market crash happened in the traditional markets, and we also saw that in the crypto markets. So normally, what we can see in the data sets here, normally prices don't really deviate that much beyond the maker and taker fees. And there's a small spread between the maker and taker fees, often just a couple of percentage points. When they get bigger, liquidators provide an arbitrage to usually pull these markets back together, and we will not see a big crash happening. Well, what actually happened, because we have a pretty young market, is that and we have a lot of different marketplaces, and we can see that in this graphic. This is three of the hundreds of different marketplaces where you can buy and sell different crypto assets, and we can see a big deviation in the price. So the maker and taker fees from the place where somebody buys and sells a asset were like really pulled apart like crazy. In the traditional market, we can see, for example, you can buy a stock at the Dow Jones, you can buy stocks at different venues, and the prices between these venues are mostly the same. But because in crypto, because we have such a young market and the liquidity providers are still pretty small, when a big whale is, for example, selling something on Bitfinex, then Bitfinex crashes, and at Bitstamp, the other exchange, or Coinbase, there is still a lot of buy volume, but the buy volume doesn't catch up with the sell volume on the other exchange. So then you get like a perpetuating like effect that the market just crashes down and just goes to the knees. Like there's a buying volume that says, okay, I want to buy it at this price. The price drops below, like let's say it drops like 10 basis points. Then the person that wants to buy it maybe for like 2 basis points less when the price is dropping, stops buying because it's like, oh shit, the market is dropping there. Let's not buy. So the whole market just crashes down, and that's why you need market makers and liquidity providers. More articles of exactly these events in the links below. So you can also see that in like the long and short squeezes that basically happened, right? The key factor for this is the liquidation strike, as I just explained, that happened between the 12th and 13th of March. there was around $1.6 billion liquidated. So basically, what happened is that the spread got bigger and bigger in different exchanges. You get like kind of market shocks, and then the market just crashed down to all these spreads, to all these long squeezes, and then a lot of liquidations happened. And as you should be aware of already, you should know what a long position and a short position is. So basically, happen when the price drops too dramatically, all the long positions get liquidated automatically, and then there is basically robots automatically sell that, and then this the whole market goes to its knees. And yeah, this happened here, and we can see that happening over here. And yeah, the liquidation bands, how you call it? These are liquidation bands because you can see that here in the red line and the green line. So normally there's liquidation bands. So normally it's like there is a price movement, and there's on the one hand you have the sell pressure and the buy pressure. And basically what happened, that buy pressure that says like, well, when the price drops like 2 or 3 basis points, I will buy it because I think it will go higher. And then there is directly a sell pressure behind that will sell it. So this is basically like arbitraging robots that automatically make money in the market. Well, what happened, these spreads were pretty thin. And then one exchange really crashed down, and then the whole market just crashed to the liquidation bands. And then the whole market just crashed down. So you can also see that if we look at the BitMEX, the liquidations of all the long positions, it went pretty severe, and the way we solve that is by having more volume in the market, having more asset classes in the market, and having stronger liquidation bands, and also having a more efficient market spread. That if in one exchange it sells, that it automatically rebalances it out more, right, and more articles on that in the description below. Let's look at some more data. There's this really interesting board that you can look at. It's from school.com, and in this board you can actually see exactly what happened in the market. So this is a cool thing that about the blockchain markets. All these data points are very well collected. Because there's actually still a lot of CeFi, like a lot of centralized exchanges. This data is not super pure, but this is not like DeFi data. It's also like more like centralized data, and I believe that if we go towards a more like decentralized exchanges, this will improve. It's a bit counterintuitive because a lot of people in the market don't say that will happen, but I think that will happen, and I also, although automated market makers and things like that are very new and very young. We will talk about those later in the course. But I believe if we go towards more like decentralized markets, these markets will also get more and more healthy as long as they get more and more liquidity, and these liquidation bands get like thicker and thicker. So then when there's a market crash, we don't have to stop it. Actually, what happened in the traditional market? If you go back to this slide, I couldn't find a graph where you can see the liquidation bands for like the Dow Jones or the traditional markets. Maybe somebody can provide me that in the forum. But what happened in the traditional market is that they put socket breakers into the system. So that means when the liquidation bands get too thin, they just stop the markets and like, oh, okay, stop it, and then they fill up the markets again. And then they open up again. So there will not be like an extreme fall to like we saw in the crypto market. We don't have socket breakers in the crypto market. It's 24-hour, 27 markets. So this is completely new. Where the stock market is only 5 days a week, and it opens and it closes. So it's a bit more easier to control. And I would say we're young. It's a very young space, but we need to grow liquidity to absorb these shocks. So this is a DeFi course. So what I just explained is more about the overall crypto market. But what happened to decentralized finance? What happened to with this market? So what happened to DeFi? Well, basically a lot of things went wrong, and we will discuss this in our next section in depth. But what we saw the transaction fee went to the roof for most of the trading pairs, so the markets could not balance out themselves. So it's a very similar situation where the liquidation bands also in the DeFi markets couldn't rebalance themselves quick enough, and that's why the whole market is crashed down. And the gas fees, you should already know what gas fees are on the Ethereum network. went to the roof. So the gas fees went super high. So people that want to move around money to balance out prices on different exchanges couldn't do that efficiently anymore. And also price oracles that rebalance and give data to different decentralized financial systems couldn't rebalance themselves quickly enough. And yeah, then a whole cascading series of events